Well, good afternoon. Mark Milam here, your mortgage professional. Happy St. Patrick's Day, March the 17th. Boy, the past couple of years I've either been in Savannah drinking green beer for St. Patrick's Day, or I've been sitting at a pub watching the SEC basketball tournament with my family. But I definitely was never quarantined inside my own house, fearing against a global pandemic. So this is a new one, I think, for all of us. And as we all adjust our personal lives to the reality of what we're dealing with, the market is adjusting as well. So first off, no, mortgage interest rates are not at 0%. I can't tell you how many times I've gotten that question in the past 48 hours, but they are at great levels. Obviously, the Fed cut the Fed funds rate this weekend down to that window of 0 to 1/4%. That is not a mortgage rate. That is a Fed funds rate. It's an overnight lending rate. We've talked about that a couple of times before in this video series. I did find a chart, just one chart for you today, comparing the Fed funds rate to mortgage rates. So this is a good one to look at. So while mortgage rates and the Fed funds rate do correlate from time to time, they are by no means in lockstep. Matter of fact, sometimes we see these really large gaps between the Fed funds rate and mortgage rates. Not as big of a gap right now, but still a pretty healthy gap. And sometimes they move in completely opposite directions from each other. They'll be going up like they did right here when the Fed funds rate is going down. So mortgage interest rates are frequently completely disconnected from the Fed funds rate. What the Fed did on Sunday that was such a haymaker for the market and really surprised everybody was they came out with this quantitative easing, the $700 billion worth of liquidity they're pumping into the market. What does quantitative easing mean? Well, quantitative easing mean? It basically means that the Fed goes from being a regulator, a setter of the Fed funds rate, into becoming a market participant. They're stepping into the market as an active purchaser now of treasuries or mortgage-backed securities. And it's the mortgage-backed securities part that really did a number and helped interest rates this week and helped us recover from the dreadful week we had last week. So the $200 billion the Fed pledged in its pocket towards buying up this excess supply of mortgage-backed securities, boy, that really helped stabilize the market, drive rates lower. So still in great territory for mortgage interest rates. Seems like the Fed is much more quicker to react now than they were back in 2008, 2009, almost as if maybe they learned their lesson that you're going to have to be really, really proactive, especially when you have something of this kind of gravity that's hitting the United States. Now, lenders, quite frankly, have become so disconnected from the mortgage-backed securities market for two reasons primarily. First of all, some lenders are so flooded with applications that they're simply worsening pricing to slow down the pipeline. That's really the only way they have to slow down and allow the customer service level to be something that's acceptable is to worsen pricing and honestly drive customers elsewhere. That's a phenomenon that we don't see too often in the lending industry. The other phenomenon is a whole bunch of us are all working from home. That's I certainly am, and most of our team is, most of the bank is. And if I talk to other lenders at other banks and independent companies, they're basically being ordered to work from home as we employ this social distancing to prevent the spread of the virus. Well, working from home is great. We've got instant messaging, we've got email, we can pick up our cell phones, but it's not the same as being in an office environment. So productivity suffering just a little bit there across the board for lenders. Another interesting phenomenon that we haven't seen before is now we're starting to hear that appraisers are reluctant to visit homes and go inside other people's homes for fear of exposure to whatever might be happening in that house. And homeowners are not super wild about appraisers coming into their home. So a little bit of a twist now with the mortgage industry, and how will the industry react to this? That's going to be a concern moving forward. Fannie Mae and Freddie Mac are supposed to put out some guidance about this tomorrow on the 18th of March. It will be very interesting to see what they say. Perhaps we're moving to exterior inspections with photographs from the listing agent that can be employed into the report. It will be fascinating to see how that all works out. In the meantime, make sure you're talking to a trusted professional who can help guide you through these times. These are really unprecedented times. I'm sure you've heard that phrase over and over again, but now more than ever, if you're interested in a refinance, if you're interested in a purchase, please be sure that you're talking to an individual that's been doing this for a while with a reputable company. Not a good time to be getting all of your information from a website. All right, if I can help you at all, please feel free to give me a call, 404-395-1102. Thanks.